Alright, hey guys, what I wanted to do in this video is talk a little bit about the S&P eMini futures contract. And at NetPicks, one question we get a lot is why don't we really put a lot of focus on the S&P eMini? Because that's apparently where everybody is at. That's where all the volume is. Obviously there's plenty of volume in a number of other markets, but why would we somewhat ignore a market that here I am at 10:40 in the morning on the day I'm recording this, and there's already 637,000 contracts traded? Because it's a great question, because if you want to do one contract, 5 contracts, 10 contracts, 25 contracts, there's definite excellent scale in this market. There's no denying that. And another nice thing about it is typically on my entries I have virtually no slippage, so that's another great thing. But a lot of times we tell people, yes, the market can be viable, but you have to typically be what we would consider an intermediate to advanced trader. And unfortunately, I think what happens, a lot of people chase this market who just start out and they get extremely frustrated. They don't understand why they're not successful. I want to give you a couple reasons and take you through a trade that I took today and kind of what I had to experience. And it's not always easy. And one of the reasons that I say this can be a tough market is, don't forget, with all this volume, you are also competing against some of the best premier day traders in the world. Okay, so with all kinds of volume that you've got here, don't forget there's a lot of really highly skilled people on both sides of the market. But take a look at this trade here that I was set up to buy at 1678.25. All right, so easy enough. And in this case, I took 10 contracts. So I placed a buy stop at 1678.25, and all I wanted out of this one was 1679.50. I've got a stretch target up here, but given the day and kind of where I was just going for my first target. So it's very reasonable, right? 1.25 points, about 62.50 per contract in this case. So nothing big. So I trigger there, no slippage at all. Even though it came through the price, I got filled in all my contracts right dead on at 78.25. Immediately, my system placed a sell limit order at 1679.50. So all good, and I had my basically emergency stop down here in case things didn't go my way. I've got to bail out. So things are going pretty well here. Market's kind of going up and down, getting really close. I'm starting to think I've got it. Then of course it fades on me, and boom, right there you can see clear as day that this market, the top of the candlestick, hit 1679.50. So I'm done, right? Nice entry at 9:11 my time, which is 10:11 Eastern, and done 4 minutes later. Well, I didn't get filled on a single contract, by the way, even though the market hit this price. And when I'm trading day-to-day crude oil, the DAX futures, unleaded gas, silver, gold, I almost always get filled the moment the market touches. It's not a guarantee, of course, if it doesn't go through, but it is the type of thing where almost always, it's rare that I don't get immediately picked up. But that's not the case in the S&P. Hit it again. Do you think I got filled? Didn't get filled. So now what do you do? And this is why I say this is an intermediate to advanced market, because it's basically done per your system. So should I mark it out? Should I just let it go possibly all the way back to the full stop even though it hit the full target? Right? It starts to get kind of really difficult to know what's the best approach, and you can actually have a lot of anxiety as a result. So here I am, and now it's starting to fade on me. Okay, good. Pop back up. Let me ask you the question again. Do you think I got filled there? No, I did not get filled. So other people were getting filled. There was clearly execution at 79.50, but you could have hundreds and hundreds of contracts, sometimes thousands, waiting to get out at a certain price. And if it doesn't go through the price on the S&P, you are not assured of fill. So starting at 9:15, 5 minutes later, I mean, and that might not sound like a lot of time looking at a chart, looking back on it, but trust me, in real time, it is kind of stressful, because you're basically thinking your system was right, you should have had your profit, you should be done, and now we're having to take pressure on the trade, we're taking heat on the trade. You have to have a strategy. So now look what happens, right? And now all of a sudden I get a short reversal potentially, and look how close it comes to potentially reversing. So just a few minutes ago I was banking my profits and ready to head into the weekend, and now I'm literally staring down a loss on a trade that hit target, and possibly having to take a short and starting all over with the process. So that's my point. You really have to have a strategy on what you're going to do. It's really easy to look at a chart in retrospect and see this happen, and see it come back and hit the target again and go, oh yeah, I mean, if I was just patient and let it execute, I would have got taken out. And look at this, it finally even went through the price. So right now, everybody's guaranteed a fill. But that was literally, this is 9:33. The first time it hit, I think, was 9:15. So 18 minutes of this, I don't know. Would you have stayed in? It's a tough call. So my advice when you trade the S&P minis, you have to have really a strategy. No matter what, you need to say something. For instance, if it hits target, the worst I'm going to do is break even. Or maybe I'm going to lock in a tick no matter what. And yes, in this case, we would have broken even or locked in a tick or two ticks. And if we would have been just really patient, eventually I would have been taken out at the full target. What I ended up doing on this trade is I actually placed the reversal at 77.25. I lowered my target down to 79.25, and I actually suffered some more because it still didn't pick me up right away, even at that price. And of course, I didn't get the full 79.50, but I got out right here. But that's tough to do. I mean, I got to tell you, there was some anxiety with this trade because I was almost reversing. Look how many times I almost reversed. 922, 923, 924, 928, 929. I mean, it was one tick away from taking me out and reversing. And if that would have happened, the trade wouldn't have worked. So bottom line on S&P Mini, please go into every trade with a clear-cut mechanical rule for what you do when it hits target on the chart, but your order does not get executed. I'm going to break even. I'm going to lock in a tick. I'm going to go ahead and just let it do whatever it does. That's pretty risky because you're going to have times where it's going to go all the way back against you. And when you're doing your testing, your performance tests, your back testing, you're probably recording a winner every single time it does this. If you want to be better in your testing and back testing, only take a winner when it goes through the price. Okay? Then you know that you'll probably always beat those numbers because there will be times you'll be picked up right at the price, but not that often, and usually not right away. All right, so that's really an explanation on the S&P Mini. Again, don't approach this market without knowing how to handle this situation. Otherwise, it'll be quite frustrating for you. So I hope that helps you a little bit with this market. It's a great market, great scale, but it does take some additional experience and some decision making that you really need to decide ahead of time so you're not kind of faced with it in real time. All right, everybody, take care and good trading.